Okay, so let's talk about policy loans and how they function inside our leveraged wealth account using cash value whole life insurance. So the example that I like to use as an analogy is that of a house and how we tap into equity because the concept is very similar to how it functions inside our policies. So in this fictitious example, let's say we own a home that's worth $200,000. Let's say we've owned that house for 10 years and we've religiously paid the mortgage and we have about $100,000 left as a mortgage balance. Therefore, we would have about $100,000 in equity, or the difference between the total value of the home and what we owe on the home, giving us the liquidity or the portion of the home that we own. Now, most of us know that even if we were to take, say, a loan out against that equity, which most banks and lending sources will allow you to do, as a third party, they'll actually allow you to tap into that equity, typically up to about 80 or 90% of that total equity amount. So in other words, you could take a separate mortgage or a second position mortgage or loan out on that equity difference. Now, the key thing to mention here is the total value of the home continues to appreciate, right? You own this, let's call it an asset for easy purposes. And let's just say in this fictitious world that the real estate market appreciates at 1 or 2 or 3% per year. That means that the value of that property at $200,000 is going to be worth 1 or 2% more each and every year, the total value of the property, regardless of what balance might be coming out of it or what's owed on it. Right? Even if you owed all the way up to the $200,000 mark, you still get that appreciation, the growth that happens on that account, on that house in this case. So the beauty of that is that we can tap into equity. So it's very, very similar to how it functions on the policy side, which we're going to talk about here in a moment. So let's take that same example and we're going to look at the side where we have a cash value life insurance policy with, let's call it the same $100,000 into it. Let's say it's been a few years, we've been paying into this policy, and we have $100,000 in cash value that's accumulated. Think of it like equity in an account. Now remember, the total value of, just like the appreciation on a property, every single year is growing guaranteed inside our policies based on the way we've structured the type of company that we work with, the insurer that is. So we're getting anywhere from 4 to 6% guaranteed growth on our money inside that policy. Now, the worst thing that you can do when you have a large lump sum, or any sum for that matter, that's getting a guaranteed rate of return, guaranteed compounding interest rate, is to withdraw the money. So if something came up in my business, professionally or personally, and I wanted to maybe take advantage of a property that was available, I wanted to reinvest in my business, or a catastrophe happened and I needed to take money out to do something with. If I were to withdraw, let's say it's $25,000 out of my policy, not only did I lessen the total balance down to $75,000, but now I have $75,000 compounding instead of that full $100,000 compounding. So each of those withdrawals on the total balance of a policy or any compounding asset drastically affects the future growth of that asset. So whenever possible, we don't want to withdraw money because it's really going to affect that compounding growth. So similar to how a bank may allow us to take out equity out of the property through the use of a loan, like a home equity line of credit, a cash out refinance, the insurer, the insurance company, that the carrier says, instead of you withdrawing that money and interrupting your compounding growth, why don't you take out a policy loan from us, just like a home equity line of credit? We know the money's in there because we can do the math and find that out. And we'll give you up to this amount that you have into it. And it's very similar. It's up to like 95 to 98% of the value, of the cash value you have in your policy, the insurance company will allow you to loan out against. And there's a couple of things that they require in return. So first, they're going to charge you an interest rate because technically speaking, you're borrowing their money, not yours. So your money stays intact here. Remember, growing and compounding at that 5 to 6% rate. The insurance company does this amazing thing. They have a loan provision in which they'll allow you to take out any amount up to that cash value, but they'll continue to pay you dividends and interest, that guaranteed growth on the entire $100,000. right? So remember over here, the entire value of the home, regardless of the loans and any other debt that I owe on that asset, the entire value still gets that growth, that appreciation. Same thing here. So even though I took a loan out for $25,000 from the insurance company, my entire $100,000 continues to compound. So I have money growing at a compounding rate, and the insurance company says, we're going to charge you an interest rate, but we're going to charge you simple interest back, simple daily accrued interest, which if you know anything about the way the interest works, that means they're just requiring interest building on the original principal that you have. That is much more favorable than compounding interest you would pay on a credit card, an amortized loan like a mortgage or a car payment. Much, much more favorable terms over the long term. The other piece is they let you set the terms of payback, if at all. And the reason for that is it's called self-collateralized. And they know that you have the money in here. But the other thing you have to keep in mind is, remember, we're actually buying a life insurance policy. And what does that mean? That means that we are paying a premium, and in its essence, we're purchasing a death benefit. And all that is a lump sum payout that the insurance company is contractually required to pay the beneficiaries that you choose. Could be your spouse, your business partner, your children, whomever that is. So they know they have to pay you out a death benefit when you pass away. If that's in 10 years, in 40 years, it doesn't matter. That's coming down the line. That's an expense they have to pay out. So what they say is, we're going to charge you simple interest on any loans that you take out, but you get to pay you get to set the term. So if you never want to pay us back, that's perfectly fine, because we know we have to pay you in the future for that death benefit, pay your family, that is. So let's say we took out this $25,000, we let it accrue over 30 years, and it grew to, say, $75,000. When the insurance company goes to pay you out that death benefit, and let's say it's a $1 million payout to your family, they will just subtract whatever you owe them in terms of loans and outstanding interest on your policy. So if you took out a bunch of different loans and interest over the course of your life against your policy, they'll just subtract whatever that total amount is from what they're going to pay your family. And then your family would get the difference, the leftover portion. So that's why they let you set the terms. The only thing they say is, hey, you pay us that simple interest, it's going to be accruing on the account. Pay us now, pay us later, don't pay us at all, it's still going to be there. If I decide that I wanted to borrow $25,000, let's say I've got a client that pays every 90 days and it's just a bridge loan to myself. I pay my payroll, I pay my expenses, and my customer pays me in 90 days. I can go ahead and just pay that loan back immediately and wipe out any of the interest and loan fees that I owe them. So you get to set the terms any way that you want. There's no underwriting process. This isn't like applying for a traditional loan. It's your money, so you can go into the portal, you click a button, you select how much up to that amount you want to take out, and it's deposited right into your account. And then you will be accruing that daily interest, but if you pay it off that day, 6 years from now, or never, the interest is only going to accrue in the amount of time you let it sit. So it's an extremely powerful tool to realize that you are getting paid compounding interest and you're paying back simple interest. So there's a bit of arbitrage just right there in the sense that you're making a spread just on the money that you're able to leverage out. That's why we call them leveraged wealth accounts, because you could have money growing in two places at once. Once guaranteed in here inside the policy at that guaranteed rate, and we could leverage it out and invest it somewhere else that might be getting a different return. So it gives you tons of flexibility and tons of control over your money. And it allows you to make sure you've got a safety net, a war chest of cash to operate with, but still allows you to be liquid and invest and take advantage of opportunities as they come up.